All right, good afternoon, everyone. My name is Mike Camara. I'm one of the financial advisors with Bogart Wealth. Thank you all for the time today. We're going to be covering the retirement planning timeline. And before we get started, I want to talk a little bit about us. Bogart Wealth, we are a registered investment advisor. We manage about 1.4 billion in assets under advisement, have about, well, at this point, almost 800 households. 90% of our clients are major oil and gas. We work in a fiduciary capacity. So what that means is we put our clients' best interests ahead of our own. There's basically two sides to the financial services industry. There's the RIA side that works as a fiduciary, and then there's the broker-dealer side. They mainly work in a suitability capacity. They're usually selling products, making commissions. So their suitability standard is basically that anything they offer has to be suitable, doesn't necessarily have to be in your best interest. So as an RIA, and we're certainly not the only one, but RIAs basically work at a higher level of client care. This is our team, about 19 people. There's me in the middle. That's our financial planning team. And then we also have our tax team. You can go to our website and read our bios online as well. We have 3 locations, one here in the Woodlands where I'm located, Houston, downtown, and McLean, Virginia, where mainly our operational group headquarters out of. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. This lists some of the things that entails. So a lot of it has to do with company benefits, but also things outside of that, such as estate planning, looking at wills, trusts, power of attorneys, Social Security maximization, cash flow planning overall, and tax optimization and preparation. Our key competencies center around, again, financial planning, investment management, tax optimization, and tax preparation. We offer one-on-one financial strategy sessions, so at no cost, no obligation, we're happy to sit down and run a retirement analysis with you. We use this as an opportunity to get to know you, your situation, and if it would be a good situation for us to help. This series is part of our, or this presentation is part of our retirement readiness series. So we're starting with the retirement planning timeline. We also have the retirement income planning, Social Security planning strategies, tax planning, tax law changes, estate planning strategies, NUA and post-retirement strategies, long-term care planning, Roth versus traditional 401ks and IRAs, and the mega backdoor Roth conversions. This one's a pretty popular one, the mega backdoor. So this is going to be more broad-based. Some of these topics we have entire presentations around. So I will basically be pointing out when there is a certain topic here that you can get more information on by attending one of these seminars. So if you want more details, please, we upload all of our presentations online and record all these. So you can go back and listen to anything that we've done here. So this is, again, our retirement planning timeline. We're starting off with what you want to look at when you're over a year from retirement. So then we're going to talk about when you're less than 1 year out, at retirement, and post-retirement. The bulk of this presentation is going to be talking about when you're over a year from retirement. So planning over 1 year out. First and foremost, you want to know the rules as it goes to your 401k, your company benefits. You also want to know the choices that you have, the investment options within your employer plan. That's centered around mainly your savings plan. All 401k plans are a little bit different. And basically, you have limited options when it comes to a 401k plan versus investing in a brokerage account, IRA, anything that you can do on an individual basis. You also want to make sure that you run your numbers, do your plan, take a look at how you're trending. And it's never too early to start. We have clients that we start working with in their 30s. The earlier you start, the more of an impact you can have over time. You want to evaluate how you're contributing to your retirement savings, whether you're doing it on a pre-tax, Roth basis, after-tax basis. And of course, you want to consider hiring an advisor. We've been doing this for a very long time. I've been doing this myself for 15 years. So I've helped probably at this point, hundreds, if not thousands of people go through retirement. One thing to make mention of is the Pension Protection Act of 2006. This was a law that made a pretty big difference in terms how corporate benefits are looked at, utilized, that type of thing. Mainly when it comes to pensions, it limits companies offering a lump sum option. It defines the discount rates that can be used when calculating a lump sum. It defines the actual tables that are going to be used as well when it comes to a pension. Non-spousal beneficiaries can do rollovers. That was a big deal. After-tax balances can roll over to a Roth IRA. That's in line with utilizing the mega backdoor Roth. And then company match can be diversified. For our ExxonMobil attendees here, as you well know, to get that extra 1% of the 7% match, used to be it had to go into the Exxon stock. That's something that's no longer the case. Well, the match is no longer the case as well. However, the contributions don't have to go into the Exxon stock for that extra 1%. Hopefully the match comes back relatively soon. It also talks about basically defined IRA and 401k contribution limits. You are obviously limited to how much money you can put into a 401k versus an IRA. 401ks, you can put a lot more versus an IRA. So in terms of the pension calculations and how that's looked at for our Exxon people, those that are grandfathered, basically over the age of 50 by the end of 2007 and more than 10 years of service before January 1st of 2008, the old rules apply. You're considered in the grandfathered category. So again, 55 and 15 by December 31st of 2012, born before 1958 and hired before 1998. This uses 90% of the 30-year Treasury bond when calculating the discount rate. So very straightforward, very simple, rounded to the nearest 0.25. One of the negatives, though, is that it uses the ExxonMobil 2,000-year mortality rate. So that's one of the negatives to that. However, the calculation with the discount rate is pretty straightforward and simple. Now, for all others, and this is probably where most people fall, is basically going to be the under 50 from December 31st, 2007. This is the non-grandfather group. The new pension rules apply. So first of all, they're using high quality corporate bond yields. Higher yield is bad. Basically, interest rates go up, the value of your lump sum value goes down. They also use Iras mortality tables. That's a good thing. Basically calculating a longer life expectancy means more pension. And then this first effective pension plan participants back in 2013, those born after 1957 or hired after 1997. We have a whole presentation. It's not listed on the retirement readiness slides there, but basically we have a whole presentation around the Exxon pension plan, how discount rates are applied. Encourage everyone to take a look at that. So this goes into 401k plans now and talks about the 401k contribution rules. I ask people a lot of times how much you're contributing to your 401k, and the response I usually get is that I'm maxing it out. When I delve a little deeper and look at what they're actually doing, they're not technically maxing it out. When they say they're maxing it out, they're thinking they're doing $19,500, which is the amount you can do on a pre-tax or Roth basis if you're under the age of 50 for 2020 through 2021. You can see the slight increase from 2019. No increase from 2020 though. If you're over the age of 50, you can do an additional 6,500, 26,000 in total if you're over the age of 50 on a pre-tax or Roth basis. However, that's not truly maxing it out. You can actually do an additional basically $38,500 on an after-tax basis. That's including the 6,500. So if you're over the age of 50 and you're basically maxing out your 401k, you would be putting in $64,500, significantly more than the $26,000 you can do with the 19.5 and the 6,500 catch up. Common misconception on that. Now, one thing to make mention of, and this is something that we're going to go into a little bit more in depth when it comes to the mega backdoor Roth, is that anything that's contributed on an after-tax basis is contributed post-tax. The way it works then is that once it's in the 401k, any growth that happens on that after-tax money is considered pre-tax. So basically, you will owe taxes on the earnings that post-tax money makes. Still beneficial though, because you are getting the benefit of compounding interest on top of that. However, if I could get that after-tax money out of the 401k plan and into a Roth, then I can get tax-free growth. And that's basically a little bit of a teaser for talking about mega backdoor Roth, but know what you're truly contributing, know what you can contribute. You have a lot of different options in terms of how you can save in your 401k plan. You need to consider whether it makes sense to do Roth contributions or pre-tax contributions. Pre-tax contributions, I'm going to make the case that if your income is high enough, we want to shelter and try and avoid taxes while you're in that high income bracket. Then usually when you go into retirement, your income drops significantly. At that point, you can pay the taxes on what you've contributed, basically. Earlier on, when your income's low and you don't have basically as much of a tax liability, makes a lot more sense to do Roths. So basically, if you have kids as well, that's something that, tell them, look at what your income is, where it could go to, and basically, if you're in a lower enough income bracket, save on a Roth. This is talking about IRAs. As I'd mentioned, 401k savings is much more robust, much higher than what you can contribute on an IRA basis. Also, an IRA is an individual retirement account. It's not tied to any employer. If you do have the option and the blessing of basically having match, you're obviously not getting that saving in an IRA. A lot of times we want to look at saving and maxing out your 401k first, making sure that you're getting match, and then any additional savings can be used in an IRA. But the limits for the IRA is much less. So for this year, you can do $6,000 if you're under the age of 50 and $1,000 extra if you're 50 and over. That's considered an additional catch-up contribution. When we're looking at IRAs, they also have traditional IRAs and Roth IRAs. So to give a breakdown of how Roth IRAs work, they have tax-free growth, tax-free withdrawals after 5 years, and reaching the age of 59 and a half. Those are the two components. And it's not 5 years from every single contribution. It's 5 years from your very first contribution. That clock does not reset every time you put money in there. So it's 5 years from contribution number one and reaching the age of 59 and a half. There are no RMDs, and RMD stands for required minimum distributions. Basically, once you're at the age of 72, any retirement monies that have not been taxed yet, you're required to start withdrawing that, whether you need the income or not. If you have a big enough balance by the age of 72, you're potentially going to be pulling out more money than you actually need and paying more taxes than you actually want to. So it's something to consider when you're looking at how to utilize and save on a Roth versus traditional IRA basis, also in terms of how you withdraw that money down the road. Beneficiaries, when they inherit Roth IRAs, inherit it tax-free, so they don't pay any taxes on it outside of basically a traditional IRA. When they inherit that, they have to pay taxes. Tax diversification as well. So if you have a big expense and you need a couple $100,000 from something, don't want to get clobbered with taxes, you can look at using a Roth IRA as a tax-free vehicle to pull money from. There are income limits in terms of how much you can make, how much you can make will limit how much you can contribute to a Roth IRA. Basically, if you make too much money, you can't put money into a Roth IRA in the traditional way. We also have a seminar that goes into detail around the difference between Roth and traditional IRAs, as well as 401ks. So as I said, if your income's too high, that's going to limit you on making a Roth contribution, but there are ways to get around that. The first way to get around that is by doing what's called a backdoor Roth contribution, or backdoor Roth is what we call it. It's essentially putting money into a traditional IRA, you don't get a deduction, and you immediately convert it into a Roth IRA. Since you did not get a deduction and did not save on taxes, you don't owe any taxes by doing the conversion. So it's basically a way to still put money into a Roth. You just have the little pit stop, basically, of putting it into the traditional IRA first. Now, the thing you have to be careful with this on is that if you have any pre-tax money, meaning money that's not been taxed yet, that you either got a deduction for, or you rolled an old 401k plan over into an IRA, then this is not going to necessarily work. And the reason that is that basically, let's say you put $7,000 into a Roth IRA and you have another $7,000 that's pre-tax money in a traditional IRA. The IRS looks at that, and when you do the conversion, they make it be a pro rata basis on how much is actually post-tax money, meaning money you didn't get a deduction for, versus how much is pre-tax money you got a deduction for. And so if you did the conversion of $7,000, only half of that would be non-taxable. The rest you would actually have to pay taxes on. So something to keep in mind, that if you are in a high income bracket at the time, it may make sense to wait. A lot of times when you retire, your income goes down pretty significantly. Waiting when you're in a lower tax bracket to do conversions is ideal. Now, this is the mega backdoor Roth strategy, a little bit more complex, and I wouldn't call this a conversion. This is a rollover. So as we had talked before, you can do a total of $38,500 on an after-tax basis into a 401k plan. And this is why we call this mega. The ExxonMobil plan allows you to pool after-tax money twice a year and basically either take it out to yourself as a distribution or roll it over directly into an IRA. So if you think, okay, $38,500 basically can go into the 401k, we can immediately roll that over to a Roth IRA without any tax implications. So that is basically one of the best ways to shell a lot of money into a Roth IRA without there being any tax implications, and especially when you're maxing out the 401k plan anyways. I just got a question. Let me look at this. Is the general account considered after tax? General account here. Oops. General account. Okay, yeah, good question. I'll get into that here in a moment. I have a copy of a statement and I'll explain what the after-tax portion is. It's a little bit confusing in terms of how the Exxon statement has it lined out there. Let me table that question and I'll come back to that. I will get to that here. So as I was saying with the mega backdoor Roth, it's a way to basically put a lot of money into a Roth IRA all at once, and to, especially when you're maxing out the 401k plan. So along the lines of the 401k plan, it's always important to know what the options are. The ExxonMobil plan doesn't have a lot of options. These are them listed here. So you have the ExxonMobil stock. I would consider this the most risky. You have the equity units, the extended market units, international equity units. I would say international probably the second most risky, extended markets third most, equity units fourth most, bond units technically not as risky, balance units, which is a combination of all these, and then the common assets, which is basically cash, pays a very nice rate of interest. And you can't find, what the interest rate is with common assets in your typical cash savings accounts at banks, even money markets and investment accounts. Common assets has a very nice rate of interest relative. I mean, nice in a very low interest rate environment, but relative to what's out there, the common assets has some pretty good rates there. So let's talk about the employer stock. Again, single stock is higher risk. One of the benefits of the ExxonMobil stock is that you can utilize NUA. We have a whole presentation around NUA that's part of our post-retirement strategies here, but we'll talk about that a little bit today. So here's what NUA is. NUA stands for net unrealized appreciation. It's basically a tax strategy. So, and this is only pertaining to company stock, employer stock. Basically, if you don't do anything with NUA, anything that's pre-tax money, meaning money that hasn't been taxed in your 401k, is taxed as ordinary income when you draw that out. Utilizing NUA basically is a way to pay capital gains taxes, which are significantly lower than instead of paying ordinary income taxes. So here's kind of a breakdown how it works. Again, pretty complex topic. We have a whole seminar around it though. So essentially your cost basis here is what you paid for the Exxon stock. Let's say you paid $5 for a share of stock. The NUA potential is basically how much that stock has gained. So if that $5 stock that you bought, again, at $5 is now worth $10, you've had a $5 gain. If you were to take out that $10 in the case of not utilizing NUA, 100% of that is taxed as ordinary income. Versus if you utilize NUA, the $5 that you had growth on, basically, again, doubling your money, $5 of growth, that's going to be taxed as long-term capital gains. Could be as low as 0%, as high as 23%. Most people are falling in the 15% bracket with that. So significantly less money that you're paying on a capital gains basis than an ordinary income basis. Another thing to make mention of with that as well is that by converting this Exxon stock from a retirement account to a non-retirement account, the dividends are also treated as qualified dividends, which are taxed at long-term capital gains rate instead of the dividends being considered income to you. So another play if you're holding on to that Exxon stock and getting those dividends, and it can save you taxes on that as well. So to the question about the general account, I'm going to get into that here. This is a breakdown of the statement here and reading your statement. So you can see what you're invested in terms of the breakdown of percentages, the amount you have there, your personal rate of return. And then when we look at the general account, the general account is actually not considered after tax. What is considered after tax is right here, this pre-87, post-86 contribution. So both of these monies, and this is just the year that the money went in there. So basically anything that went in post-86, which is going to be for most people, that's this bucket. Anything that went in there prior to 1987 is this bucket, all considered post-tax monies. A lot of people get confused in looking at this after-tax account and think that this is the total that they have on an after-tax basis, which is not the case. What this after-tax account represents is the post-tax money plus the earnings. So if you look at this, this is in total what you've actually already paid taxes on, where there's the opportunity to roll this money out into a Roth IRA. And then this is what this $273,000 has earned, up to $562,000. So in the instance of basically putting in this after-tax money, it's in total worth $562,000. If I've been taking this out every year and rolling it over to a Roth IRA, basically this earnings that we're at right now, the value being $562,000, this will be totally tax-free for me as long as I wait till 59.5 to withdraw it. Right now, as it stands, this growth is going to be taxable when you withdraw it. So this is one of the most powerful tools at our disposal that we can use to optimize the savings. I hope that answered the question there. So this is, again, just blows it up here. Pre-87, post-86 contributions, just to re-emphasize that this is the money that you've actually paid taxes on. So one of the nice things with the ExxonMobil plan is that Voya keeps track of every single share that you ever bought of ExxonMobil stock. So you can see what your cost basis is based on the range of what you bought, how many shares you have, and what the total cost is. So essentially, whenever we're looking at whether it makes sense to do NUA or not, we're going to take a look at what the cost basis is on the shares. If you got a lot of shares you bought at $14 and even I'd say up to $28, $35, we're going to look at NUA as a big play for this. If we got nothing but shares in the 87, 88, 89, it doesn't make sense in this environment to do NUA. Down the road, I don't think it's going to make sense either. Hard to say what Exxon stock's going to do exactly, but it could be some time before we get back up to this price range. So the more shares of stock you have at a lower cost, the more NUA can save you down the road. So when you're reading your statement, and especially when you reach the age of 50, you got to be careful in terms of how you're saving and making sure that if you want to put some additional money in on a catch-up contribution, you do it the right way. First of all, when there's no catch-up contributions available, you'll see it listed here. You can put money in on a before-tax basis, Roth account basis, or after-tax basis. And then when you have catch-up contributions, you don't actually elect a percentage. You elect a dollar amount. And so you can space it out to basically make sure you get to the $6,500 by the end of the year. But basically, you put in a dollar amount. So just make sure that when you're electing catch-up contributions, don't just assume that this percentage is automatically going to spill over to catch up. You have to actually go in and elect it and put in a dollar amount. A little quirky, a little different, but it's just something you got to make sure you do, especially when you're at the age of 50, or only at the age of 50, because that's when you can do it. So this is going a little bit into detail in terms of what the investment options are with the 401k plan. So we talked about the employer stock there. Talked a little bit about the NUA benefit with that. Then we have the equity units. This basically tracks the S&P 500. So it's going to mirror pretty much whatever the S&P is doing. It's 500 of the largest US companies, represents about 70 to 80% of the market value of all publicly traded US companies. Beyond that, then you have the extended market units. Think of this as mid and small companies. It approximates the Wilshire 4500 index, and it includes all publicly traded US companies minus the S&P 500, basically. We then have international units. This tracks the IFA, and it's large and mid-cap companies in 21 developed countries. You can see the list here of some of them: Australia, Austria, New Zealand, Portugal, so on and so forth. Currently has 918 companies within it, representing about 85% of market capitalization in each country. So pretty big index in that sense. Then you have the bond units. So this basically tracks the Barclays Capital Aggregate Bond Index, represents about 17,000 bonds and publicly traded in the US. It's a mix of government, corporate, and mortgage bonds. It does not include high yield bonds, municipal bonds, inflation index bonds, and bonds denominated in non-US currency. So these, like high yield bonds, bonds that are foreign, those are more risky bonds. So this is not, a risky bond strategy in that sense. Now, the thing you need to be careful of when you're deciding how to invest your money in your 401k plan is basically looking at things holistically. One of the things I'm constantly having conversation with people about is not to just look at your 401k, but look at your IRAs, your pension. So if your target is to have, if you're coming up on retirement and you want to have about 50% stock exposure and 50% bond exposure, if you look at your 401k and I'm just going to say 50% in the equity units and then 50% in the bond units, well, okay, you think you're in a 50-50 mix, but then factor in your pension. Your pension is not affected by the market. Your pension is basically bonds. So it's affected by interest rates. If interest rates go up, the lump sum value goes down. If we're taking the annuity, then interest rates don't even factor. The three things that affect your pension are your years of service, your age when you collect it, and your compensation while you're working with the company. Typically, as any of those three things go up, your pension value goes up as well. So the pension's a very conservative investment. It's money. And regardless of what the market does, we could go through another COVID environment. The market could collapse 30%. That's not going to affect your pension. The thing that affects your pension is, again, those three things I mentioned in terms of years of service, compensation, and age when you collect it, and interest rates. So if you truly want to have a 50-50 mix of stocks to bonds, and let's say you have $1 million 401k and $1 million pension, well, then I would put 100% in equities in the 401k to balance out how conservative my pension is. So it's just something to think about in that regard. When we look at things, we like to look at things holistically. And that's just a simple example of the 401k and the pension. Start throwing in non-retirement accounts you have outside your employer, IRAs, things like that. You got to fit it all together. This is the balanced fund units. Oops, went over too much. The balanced fund units is basically kind of a one-stop shop. If you want to put it into something that's going to be diversified amongst the limited options within the 401k plan, it's going to basically be made up of 35% equity units, about 15% extended, 25% international, and 25% bonds. So this is what the breakup of the balanced units is. I'll make the case again that looking at things holistically, it doesn't necessarily make sense to be doubling down on the bonds when you have a very large portion of your money that's already basically invested in bonds. Oh, I think I had another question. So once you already have after-tax balance, does this method have tax implications? So just to go back, that's a question around the mega backdoor Roth. No, there are no tax implications. Basically, if you have any after-tax money in the Exxon 401k plan, you can pull money from there, roll it over to an IRA, and there are no tax implications. It's basically moving money from one place to another. By doing that, you're moving it out of the after-tax bucket into the Roth bucket, and it's growing tax-free, no taxes whatsoever. You're not receiving the money, you're moving it from one account to another. So again, tax-free. All right, and this is common assets. The safest investment you can put your money into within the plan has a $1 price per share target. Variable yield, again, more attractive than what you can find in savings accounts and things like that. Generally, again, it's overall better than a money market where we can find in IRAs and things like that. So it is a very safe, relatively higher yielding investment. So going back to evaluating your contributions, you need to, first of all, look at your cash flow. How much can you actually put into the 401k? Can you squeeze out an extra % or two? What investment choices do you want to do? Like I said, you want to look at it holistically. Look at things, not only just the 401k by itself, but everything else you have going on. Do you want to do a pre-tax, Roth, or after-tax savings? Like I said, if you're in a very high income tax bracket now, shelter as much as your money as you can, save it on a pre-tax basis, and then down the road, when you're in a lower tax bracket, then you pay the taxes. If you're starting off, you're young, or maybe this is a conversation you have with your kids. When they start off, they want to be doing more on a Roth basis because they're in a lower income tax bracket. Pay the taxes now, don't pay the taxes down the road, basically. So you want to take a look at basically how you're saving and strategize around that. It's very important to really have a plan in terms of how you're saving. Don't just throw it in half pre-tax, half Roth, and then a little bit after tax. Got to be a little bit more strategic than that. And again, the tax paid balance, if you have tax paid balance in there, consider pulling it out and rolling it into a Roth. It's a no-brainer in my book. So this is the ExxonMobil pension estimator. The ExxonMobil plan basically looks at multiplying 1.6 times your years of service, times your compensation, and then they have a Social Security reduction factor, and then that's what your basically annuity is. When it comes to the lump sum, they calculate out basically what your annuity is, factoring in discount rates. But bottom line is, as discount rates go up, lump sum values go down. If you aren't signed up for our ExxonMobil people, if you aren't signed up for our weekly newsletter that we send out around discount rates and projections, send me an email or send one of us an email. We send out every week projections around what the discount rate is looking to do. For the third quarter, we are expecting a pretty significant uptick. Right now, it's looking at about 0.4 increase from the previous quarter, so not insignificant. All else equal, 1% increase in interest rates has about a 10% drawdown or negative draw on your lump sum value. So, 0.4 is pretty significant. Now, one of the most important decisions you have to make when you have a pension, especially with the Exxon pension, is whether you take a lump sum or an annuity. Both have pros and cons. And as a high level, I'd like to go over some of the pros and cons to consider. Let's start with the annuity. The biggest thing with the annuity that people like is that it's very conservative. It's simple. You get a monthly payment that is going to last theoretically for the rest of your life. So it's very conservative, regardless of what the market does. It's not going to affect your monthly amount. What is negative about it, and here's some of the negatives about it, is that it does not go up. This is not the case for all pensions, but when we're looking at the Exxon pension, it is a fixed amount. There's no cost of living adjustment. So let's say you get $9,000 a month. Whatever $9,000 buys today in goods and services is going to be less than it buys in 10 years down the road, 15 years down the road, 20 years down the road. Basically, that's inflation eating away at the value of that fixed amount. Now, the other thing to factor in is that the Exxon pension allows you to, and all pensions do when it comes to an annuity, allows you to name your spouse as your beneficiary. So you can basically have 50% go to her, 75% go to her, or 100%. The higher amount of coverage that you have for your wife, the less of a payment you get. So your wife is covered if something happens to you, or your spouse, I should say, husband or wife. Basically, if something happens to the wife who's collecting the pension, the husband would get 50% of that theoretically. Then if something happens to that husband, that's it. The pension stops, no more payments, nothing goes to the kids. Probably one of the biggest factors when determining how you want to take this, basically. And a lot of people don't like that, obviously. God forbid if, husband and wife are in a car, something happens to both of them in an accident, and they're collecting a pension, it's going to go away. So that's one of the bigger factors to consider. Now, the lump sum is basically kind of taking your money and running. You take the payment, you don't cash it out to yourself. That would be a taxable event. So you don't want to do that. You roll it over to an IRA, keep it tax deferred, draw on it as needed. So the good with that basically is you have complete control. You can pull however much you want to. You want to take the same amount that the annuity would pay you, you can do that. If you want to take less, you can do that. If you want to take more, you can do that. The negative with it is that you have to invest it. You have to do something with it. It's not advisable to just have it sit in cash. The other benefit with it, though, on the other side of that is that you can grow it. By investing it, you can theoretically keep pace with inflation and have more money overall. But investing involves risk, and technically it's a finite amount of money that could run out. The biggest benefit, as I see it with the lump sum, is that if something happens to whoever is the owner of the lump sum of the pension, let's say the wife again has received the lump sum, she's the Exxon employee, something happens to her, she can have the husband as the primary beneficiary, something happens to him, kids are then contingent beneficiaries as well as grandkids, whatever. It's always going to stay in your estate, in your legacy. So that money will always pass on. So when you're looking at basically the annuity, there's no principal balance on that. You're just getting a fixed cash flow versus the lump sum is a chunk of money that basically you can utilize however you see fit. Again, a little bit more complex, got to invest it, got to do something with it, put together cash flow summaries, or excuse me, cash flow strategy. So it's a more of a complex way to go. This is now looking at the savings plans option. So I'll cover the saving plan options. One of them is certainly not advisable. The first one is that you can take a lump sum distribution and just pay it out to yourself. It's going to be a pretty big tax hit if you do that. The second option is to keep it in the plan. The 401k plan could stay in the Voya plan, and for most 401k plans, you can stay in the 401k plan basically as long as you want to. Once you reach the age of 72, you will have to start taking distributions from that for those required minimum distributions I mentioned earlier on. So that doesn't protect from that or anything, but you can keep it in the plan if you really like the 401k plan for whatever reason. The other options are to roll it to an IRA. You can roll it to an annuity and set up a stream of income. But basically, the NUA option is an option that if you utilize it, you have to take out all the money from the 401k plan. You can't just take out the Exxon stock, utilize NUA, and then keep the other monies in the 401k plan indefinitely. It all has to come out within a year if you utilize NUA. So keep that in mind when you're considering things. So when you look at the savings plan distribution, basically, this is just kind of looking at what I mentioned before. If you take it all out to yourself as cash, it's 100% taxable. Any stock that you have can be rolled in kind, meaning that you do not have to sell any employer stock. You can utilize NUA with some of it. Any shares that basically are above the cost basis that we want to use can go into a regular IRA. And then we just hold it until we decide on basically when and how we want to sell it. Anything that's not stock that we roll over to an IRA, there's no tax implications. And there's no tax implications if there are with NUA, but basically there's no tax implications with anything we roll in kind stock-wise to an IRA as well. This is just an illustration of the Exxon plan and kind of how it would break down if we utilized NUA. So any Exxon shares that we did NUA with, do you have to sell Exxon stock to trigger NUA? Good question. Technically, you do. You don't get the benefit of NUA until you actually sell the stock. So what I mean by that is that when you roll over that money, that Exxon stock into a non-retirement account, basically, you still have that long-term capital gain that you haven't realized. So you don't get the benefit of it until you sell the stock and use the money, basically. So if you have, I'm just going to throw a number out there. If you have $30,000 of capital gains, it's going to be taxed at long-term capital gains. You don't get the benefit of it until you sell the stock, because theoretically, Exxon value could go down, and that 30,000 of gain could whittle down to 25, 20, 15, whatever. So you don't actually see the benefit of NUA till you technically sell the stock. You don't have to do it immediately. You can hold on to that stock and have that long-term capital gain as long as you want to. The longer you, and it could go the other way. If you hold it and that 30,000 Exxon starts going up in value, goes to 35, 40,000, those gains are still going to be long-term capital gains. So basically you get the benefit of it whenever you sell the stock and utilize the money. And that can be, using it for yourself, using it for a big purchase, or just reinvesting it and diversifying it. Can you take out common assets and keep Exxon stock in the Exxon plan to take advantage of NUA? No, if you take any money out, if you take basically so the question is, can you take out the common assets and keep the Exxon stock in the Exxon plan to take advantage of NUA? Technically, no. If you take money out of the plan, it all has to come out in utilizing NUA. So you can't just kind of take a little bit here or there and utilize NUA. So it all has to come out, basically. So this then again gives a breakdown of the savings plan and how it would work. Exxon shares that we utilize NUA would go into a non-retirement account that can be set up as an individual account, a joint account, a trust account. The Exxon shares that were too expensive, basically, that we didn't do NUA on, would go into just a regular IRA, hold on to it, decide to sell it whenever we want to. And then anything that's basically not Exxon stock, your balance units, your equity units, bond units, liquidated as cash goes into a regular IRA. And then any after tax, and by after tax, I mean post-tax, pre-86, post-87 monies, or Roth 401k monies would roll over into a Roth IRA. So this is typical of the breakdown when we do a savings plan rollover. So why rollover? In terms of, a lot of people do make that option, or choose that option, I should say. First of all, professional management. If you have the money in the Voya plan, there's really not an option to have somebody manage it and choose the investments and rebalance it for you. Reduce stress so that somebody is looking over it and doing it for you, and much greater choices. Obviously, there's 6 choices within the Voya plan. There's literally hundreds of thousands that you can invest in within an IRA when we factor in individual bonds, basically. A lot of different choices. This lists just some of the ones that are out there: real estate investment trusts, international bonds, alternative investments, covered calls, and you can also set price orders. So with the Exxon Voya plan, if you wanted to sell Exxon at $70, let's say, and that's the only price you want to sell it at, you got to keep watching the Exxon stock and basically get in there and sell it, when it hits 70 yourself. Within an IRA, you can actually set a price target that says, okay, if Exxon hits 70, execute immediately, sell 1,000 shares, and it just happens. So you can kind of set it and forget it, not be tracking the Exxon stock. So management is a little bit easier, a lot easier, I should say, within an IRA in terms of doing things. The fixed income choices are certainly more robust within a IRA than a Voya 401k. Individual bonds you can do as opposed to just the bond fund. You can find some better yields. And then access, basically. You can only pull money from the Voya plan once or twice a year, versus an IRA. You can pull it every day if you want to. You can pull it monthly, weekly, whatever. You can set it up however you want to in terms of access to the money. So there's no restrictions. If you can only pull money from an account once a year, you got to be very careful with the budgeting, basically. So this just gives some stats on rollovers. About 200 billion rolls over annually, 548 million a day, 22 million an hour. Some pretty big numbers. Most people do end up rolling out of their 401k plan. So once you get to basically the point of getting close to retirement, you need to start determining your retirement income need. There's going to be a number of different sources of income: Social Security, pensions, personal savings, maybe part-time employment. There's a number of ways to generate income. So let's talk about a few of them. First of all, Social Security. This replaces anywhere from 90% to theoretically less than 1% of your overall income. Basically, the more money you make, the less Social Security is going to replace. For the US median income, it replaces about 40%. For the typical oil industry employee, it'll be anywhere from 10 to 30%. Now you have also your pension, and this is assuming an annuity. A fixed annuity replaces anywhere from 12 to 70% of earnings. Depending on age, again, it's calculated by 1.6% times years of service times average pay minus Social Security offset. The typical career employee, the pension annuity can replace around 50% at age 60. Then, okay, let's say you're getting about 50% replaced by your pension, another 10% replaced by Social Security. That's 60%. We still have about a 40% gap. So then we have to look at savings, 401ks, IRAs, other employer plans. That's what you got to use to fill the gap. So cash flow planning is looking at basically how does it all fit together. Social Security and pension are guaranteed sources of income, meaning that regardless of what the market does, and as long as you live, Social Security, again, theoretically, we all know that Social Security is not in a great place right now, but theoretically, Social Security is designed to pay for the rest of your life, as is a pension annuity. You can also look at what you need for short-term liquidity. So for the short term, in terms of basically making sure that the first anywhere from 3 to 5 years of retirement are funded, making sure you have liquidity. You don't want everything tied up in an annuity, something that basically you don't have the capability to, draw a little bit more out of, draw less out of. You need to have some flexibility on top of the guaranteed income sources you have. Ways to do that are basically putting together an investment strategy that you can get income off of, dividend paying stocks, or just realizing appreciation and drawing from that. Bond ladders pay interest. Interest rates are very low right now. It's very hard to be a conservative investor and meet your cash flow needs. Unfortunately, in order to get enough growth, you typically have to have stock exposure. Covered calls are another strategy that we utilize when it comes to employer stock, especially when you have very concentrated stock. A covered call is basically a contract you can enter that gives the other person or another person on the other end of that contract the right to buy your stock at a certain price. So in the case of, like, let's say Exxon, let's say you're comfortable with selling it at 65. You don't want to sell it below that, but you want to sell it at 65. You can enter a covered call that basically says if Exxon hits 65, you're obligated to sell it. The other person on the other end would buy it from you, and you get rid of it at the price you want. If it never hits 65, because you've entered this contract, you actually are paid a premium. So it's another way to get some additional income off it outside of the dividend that Exxon pays, which is pretty nice at this point still. I think right now it's yielding about 5 point something at this point. So now we have to look at tax liability. And when you're looking at your total retirement scenario, leading up to retirement, in retirement, you got to look at how do taxes play in. So when you're looking at your assets and what's generating interest income is taxed at ordinary income rates typically. That's usually better held in qualified accounts. Qualified accounts are another phrase for retirement accounts. Your interest income, even if you don't collect it in a non-retirement account, is taxable to you. Holding it in a retirement account, either a Roth or a regular retirement account, is either going to have it growing tax-free in the case of the Roth with the interest income, or it's going to be basically growing tax deferred. So you don't owe any taxes on it to withdraw the money. You also want to look at holding assets that generate dividends or capital gains in non-retirement accounts. Qualified dividends and capital gains are taxed at long-term capital gains rates. Like I mentioned, for most people, 15%. You want to use distributions from different account types and different assets. Withdraw qualified assets before required to reduce future tax bills. So basically that's looking at, okay, if you have a very large IRA and you have non-retirement money that you're just drawing on till 72, at 72, that IRA has grown significantly. And that's going to be all the more you have to take out at the required distribution age. So not only is it potentially, advisable to withdraw some of that money, but I'd also look at doing Roth conversions at that point. If you can control what your income is post-retirement, you can do some Roth conversions, spread out the tax liability over time instead of getting clobbered with it at 72. And then as you get older, you have to take out more. By the time you're late 70s, early 80s, that tax bill can be significant. So you also want to focus on maximizing lifetime after-tax income instead of minimizing the current tax bill. So that's, again, don't basically look at saving taxes in just the year. Look at saving taxes over your lifetime. This just talks a little bit about the type of income and the taxability. Social Security, a portion is taxed as ordinary income, typically 85%. Pension income, taxed as ordinary income. I'd mentioned interest income, taxed as ordinary income. IRA, 401k distributions, taxed as ordinary income, unless it's a Roth. Qualified dividend income, long-term capital gains rates, same with long-term capital gains. Roth IRAs, no taxes whatsoever. Investment principal on a non-retirement account, so basically what you paid for it, you don't get taxed again, not subject to taxation. This is just a breakdown of ordinary income versus capital tax rate. So you can see that if you're falling in this bracket, this is what you're paying in capital gains, basically. So most people, when they're working, are not going to be able to enjoy a 0% capital gains rate. Usually, like I said, they're falling in 15%, some cases higher. But whatever rate you're at versus capital gains are always going to be lower. And if you have some very highly appreciated stock, mutual funds, ETFs, when you retire, there's going to be some opportunity to sell those positions, realize the capital gains, and potentially not pay any taxes on it if you're careful with what you're doing with your income. So that's what we need to look at when we're putting together a plan is how do we utilize the investments and the assets you have to minimize taxes strategically. And so putting all this together is where the holistic planning comes into play. We're also wanting to be looking at, if you have non-retirement money, utilizing that. And that's where we're doing Roth conversions to basically maybe fill up the bracket to the brim here at 22%. And then look at, okay, next year, do we have enough to live off of and convert money up to the point that we're comfortable with doing so that we're saving and spreading out the tax liability over the years. And when we're at 72, it's less that we have to take out. And that's with the assumption that tax brackets are the same. Who knows what tax brackets are going to be like at the age of 72? Are they going to go up? Probably. Doesn't mean they always are going, the taxes don't always go up. Tax rates fluctuate like anything else. But most people assume that tax rates are going to go higher. We're probably going to see higher tax rates in the near future with the current administration. So cash flow planning for early retirement. So this is pre-59 and a half. Just to emphasize what this is talking about. If you withdraw money typically from a IRA, pre-tax money, prior to the age of 59 and a half, you have a 10% early withdrawal penalty. So if you retire at 55, the question is, how do I bridge to 59 and a half, especially if most, if not all of my money is pre-tax money? So there's various ways to do that. The first way is that if you have some additional savings that's non-retirement money, utilize that to get you to 59 and a half. NUA can be another option with that because you're converting those shares from retirement monies basically to non-retirement money. Look at doing part-time or consulting, part-time work can get you there. The 401k. So the 401k is probably one of the bigger go-tos for this. There's a certain rule called the rule of 55. Maybe you've heard of it, maybe not. Most people haven't. Basically, the rule stands as follows. And this is why we say don't make a big decision with your 401k right away. Consider your options, consider what you need to do, consider your age. If you retire from a company at the age of 55 or later, you can actually pull money directly from a 401k and not get hit with that 10% penalty. It's one of the few rules of getting out of the 10% penalty if you're under the age of 59 and a half. Now, the caveat to that is that the 401k's got to stay there and you got to pull money directly from it. So in the case of Voya, you can only pull once or twice a year. So the budgeting is tricky, but I'll make that sacrifice in order to save myself 10% on what I'm pulling out there. Got to be strategic with it, maybe pull a little bit extra as a cushion, but that's going to save you 10%. The thing to keep in mind, though, that if you're 55 and you take that 401k and roll it over to an IRA and then you pull the money out, that 10% penalty is going to come back into play, basically, if you're under the age of 59 and a half. So 55, if you retire, you can pull money directly from the 401k, no 10% penalty. But again, it's got to stay in the 401k. You cannot roll it over to an IRA. Another option is a 72T. Basically, it's setting up a short annuity where you pay yourself an equal amount of money over 5 years from an IRA. It's a way to avoid the 10% penalty. The thing with that, though, is it's very specific. You have to pay yourself the exact same amount every year. If you go above or below that, they can look at that as a violation and go back and penalize and tax you on it. So it's not one I usually like to go to if I have these other options, basically kind of use this as a last resort. And then above and beyond that, a line of credit is a way to go. Don't necessarily like the idea of borrowing money to finance your lifestyle, but if we're looking at, okay, interest rates are pretty low right now. If I can get a 3%, interest rate on money I borrow, pay it off within a few years, save 10%, it may make sense to do. But I would say, in terms of the routes I'd like to go, non-retirement money first and foremost, if you want to go back part-time, something to consider, but I would say savings plans, 401k plans, NUA kind of falls into the 401k category, 72Ts and line of credits as last resorts. So it's complicated, obviously. You need to have a plan. You need to put it all together. So a lot of factors you need to consider. Risk management is looking at insurance needs. Typically, when you're younger, you need more life insurance. You need to make sure the kids are taken care of, the spouse is taken care of, college, all that good stuff. As the kids get through college, as you pay down your debt, as your net worth increases, then typically you don't need as much life insurance. You don't need to be paying those higher premiums. The life insurance need typically goes down the older you get. Estate planning, I mentioned this before, that's looking at wills, trusts, power of attorneys, making sure that when your money is inherited, it's inherited based on your wishes, having some guardrails around how that money is inherited. One stat I like to throw out there is that on average, a 30-year-old or younger that inherits $1 million when there's no guardrails, that money lasts about 9 months. It's a crazy statistic, but that's what's out there. Investments, how do I invest my money? Obviously, time management, figuring all this stuff out. You can delegate that to an advisor. Cash flow, again, how do I pay myself? Market forces, COVID, like last year, new laws, Secure Act, and again, taxes. All this is centered around your plan, and this is what holistic planning looks like. So why is spending so important? Basically, a difference of 1% or 2% in a withdrawal rate can make a big difference. If you're basically looking at an investment return of 5%, inflation at 2%, so if we net this out, that's a real return of 3%. A 3% withdrawal rate obviously is going to basically last indefinitely. If you have a 4% rate of return, the money theoretically would last about 43 years. If you have a 5% rate of return, we're looking at about 29, 6%, 22, and then 8%, we're looking at about 15. So it can be a big difference. May not seem like a lot, going from 4% to 6%, but you can see what the difference is. Now, this is, again, assuming a certain flat rate of return. The other thing that's important to keep in mind is sequence of returns. So if you're getting a certain average rate of return, and if you get, that's not the way the market's obviously going to work. It's not just going to be an average of 5% or 6% every single year. Some years it'll make 10%, other years it'll lose 3%. That's just the way the market works. What can be a factor in this is also when those returns happen. So if you catch good years first, if you get your first year of retirement, the market makes 12%, the next year of retirement, it makes 15%. Year after that, you make 8%. You're catching some really good years. You're starting off ahead. Go the other way, 2008 type scenario. First year of retirement, the market loses 30%. Year after that, the market's still down 10%. And that's going to, but overall, over your lifetime, it averages, let's say, 5%. Based on when those returns happen can be the difference of whether you actually run out of money or not. So sequence of returns and how you structure your investments and that short-term liquidity need is very important. So you got to do the analysis. You got to look at your retirement planning cash flow needs. You got to look at doing an annuity versus a lump sum. You got to look at whether NUA is optimal for you. Got to look at how your portfolio is, how you're invested. Are you taking on too much risk, too little risk? Do you have enough growth potential for this money to last your lifetime? That's, again, in terms of portfolio risk analysis. Your personalized asset allocation, that's looking at, how comfortable are you with taking on risk? One of the most important things that we emphasize is sticking with the plan and staying invested. A lot of times when the market collapses and goes down, like we saw last year, 30%, what an investor does is immediately get out. They can't take that downswing. And so when you get out, you've actually realized that loss. That 30% that you were down, that's realized. If you are down 30%, you stay invested, you have the same amount of shares, they're just worth less. You stay invested and let the market recover. Well, like we saw last year, the market got back to break even, what was it, about July? And the S&P finished up 18% last year. Who would have thought that? I didn't think that when COVID was happening, but it did. And so staying invested is one of the most important things you can do when it comes to making sure that your retirement scenario is going to work, because too many times people get out of the market at the wrong time. They sell the loss. And then what they do is they sit on the sidelines, they wait for the market to go back up, and then they see, okay, Dow's hitting all-time highs, and then they buy back in. So they get hit both sides. They realize the loss, they sit on the sidelines. When the market goes back up, then they buy back in. So they realize the loss and they don't capture any of the upside. That's how you can really hurt yourself. So your personalized asset allocation, the mix of stocks and bonds, is going to determine how much volatility you have, how much you're comfortable with, and overall making sure that the volatility characteristics are what you can handle so you don't make that knee-jerk reaction and just get out of the market because you're down so much. Roth IRA analysis, that's going to be looking at, whether an IRA makes sense, whether conversions make sense down the road. Insurance analysis, talked about that a bit. Long-term care is a big one. Long-term care is something that is very expensive, like anything medical-wise, and it's something that a lot of people potentially could face. So options are to look at getting insurance for that. Insurance is very costly these days, or self-funding. So we have a whole presentation around that as well. I encourage you to look at that. And then Social Security optimization, we have a presentation around that, but that's also looking at, how do I collect Social Security? Do I collect it early at 62? Do I collect it at normal retirement age? Or do I delay it till 70? The other thing you have to factor in is not just your Social Security, but yours and your spouse. We want to look at a household, especially when one person's Social Security is significantly less than the other. You got to weigh both people's, because basically if the higher Social Security income earner passes away, the spouse can actually go on their Social Security. So you got to consider that when you're deciding when to collect Social Security. So when you have an advisor, the things you want to look for in an advisor, we suggest at least, is to make sure that they have a very transparent fee structure. That's again going to be when you're looking at an insurance agent, someone that's selling annuities, a lot of times there's a lot of hidden fees in those. Sometimes the insurance salesman doesn't even understand how the fee structure works, but you want to make sure you have a very transparent fee structure so that you understand exactly what you're paying, because an extra 0.5% or 0.25% over 30 years, that can really eat away at your assets. You got to have a very clear understanding on what you're paying. Qualifications and experience, certified financial planners, that's just kind of the ticket to play. You got to be working with a CFP. They need to know your retirement plan and basically be able to, help you navigate the rules and regulations on, specifics there. ExxonMobil is a great example. There's a lot of little quirks in there that, most people don't know offhand. Need to know the Iras retirement rules, rule of 55 when it comes to the 401k, early withdrawal penalties, things like that. We suggest having an advisor that has at least 15 years of experience, and that they manage portfolios in-house and don't just delegate that to a third party, so that you can basically have a little bit more transparency with that. You want an advisor that's open to discussing various strategies. Basically what that means is they're not just putting you in a one-size-fits-all thing. Everyone's situation is different. You got to look at being flexible and having different strategies, not just everybody does this. Also, you want to make sure you track your performance and you have a target that you need to hit. This is what I need to average in order for my plan to work on my investment returns, basically. And then, am I hitting that? Am I tracking that year over year? And then again, understandable, speaks in a way you can understand, doesn't throw out a lot of lingo. You want to have an understanding of what your situation is. Even if you're delegating, the heavy lifting and the figuring out of the plan, you want to at least have an understanding of what's going on with that. So this talks a little bit now when we're getting basically less than 1 year out, what you need to be looking at. So when we're looking at for more on the post-retirement, please consider, the retirement income planning and the NUA retirement strategies as some additional seminars to go to that we have here. So under 1 year out, you got to determine and refine your income need. You got to know how much you need to live off, basically, and not just how much you need to live off, but how much you want to live off. So it's also, factoring in some fun spending, travel, maybe a beach house, whatever the case may be. That's where we run the various scenarios. We treat retirement planning as something that's never done. So when we put together a plan, it's not, okay, here's your plan, you look good, good luck, I hope it works for the next 30 years. That's something you want to keep revisiting at least once a year. So again, consider hiring an advisor to put this all together for you. Consider a trial account with an investment advisor. Start off by giving them $20,000, $50,000, $100,000. See how they do, see how they operate, see what type of customer service you get. That's very important. And just try them out before you commit your life savings to anybody. Also, again, determine your cash flow plan. Emphasize that numerous times. Under 59.5 versus over 59.5, the strategy on how you utilize your money is going to be drastically different. You got to review the possible investment plans, watch the discount rate when it comes to a lump sum on the pension, know the year-end leave rule. That's for Exxon, basically. As long as you are working till December 31st, you'll get your vacation for the following year. And then again, evaluate your work situation. How's the work conditions right now? Do you think you're going to potentially have to, face a PIP in the future? Whatever the case may be. If you're in a situation that's a little precarious, then good time to start looking at this stuff and planning for worst case scenarios, basically. So when you're 100 to 0 days out, basically this is in terms of finalizing a retirement date. So there's 3 key dates. It's your last day on payroll, the first day of retirement, and then your benefit commencement date. The benefit commencement date is in relation to your pension. So when you request an intent to retire package from benefits, that's basically all centered around your pension. That's where you elect what your commencement date is. That's going to be the earliest commencement date you can have is the first of the month following your last day with the company. You want to inform your supervisor of any of these key dates in writing. Submit your pay in lieu vacation form. Then you receive the intent to retire package. You got to return that as well. Plan your retirement party. Turn in the laptop, badge, mobile. Pretty basic stuff on that last front. So the intent to retire package, again, primarily related to the pension. It also contains some health benefit information, but it's not used to change health benefits. You actually do that online. So you need to complete the forms and get them back to benefits. You select whether you take the lump sum or the annuity. The Exxon plan also offers a combination. So you can do half annuity, half lump sum if you want to. If you take an annuity, you got to select the type of tax withholding you want to do. If you take a lump sum, select which IRA custodian you want to roll it over to. Have your advisor look through it, make sure you fill it out correctly. I've done hundreds of these, I think, at this point. Read the tax disclosure, notarize in 3 places. So 2 if you're single, more if you have the SPP or APP benefit. The tax disclosure, just to come back to that, is what's called a special tax and distribution notice. That's more in line for when you call to Voya and do a rollover of your 401k plan. They're going to ask you if you've received and read the tax notice, the tax disclosure. It's in the ITR package. They're not going to quiz you on it. You don't technically have to read it, but you got to tell them you've received it and read it. You can skim it if you want to. If it's not returned, the packet at least 35 days prior to your commencement date, the pension benefit will be delayed. Typically, it's 1 month out. So if you get it back, if your commencement date's June 1st and you don't get it back till like May 15th, you're not going to receive your paycheck until July 1st. If you get it back 35 days prior to June 1st, you'll get that pension check on June the 1st. When to consider delaying your pension. So first of all, with an annuity, if that's the way you're going, if you don't need the money right away. If you're retiring before the age of 60, when it comes to the lump sum, basically 55 to 60, every year you delay the pension, even if you're not working, you get a 5% increase to it. Now, the thing you got to factor in, of course, is what are interest rates doing? As I mentioned before, a 1% tick up in interest rates is a 10% decrease in your pension lump sum. So if interest rates go up over 2 years and you're waiting 2 years, you're going to even out basically because the pension's going to go down, or excuse me, if interest rates go up by 1% and you wait 2 years, you're losing 10%, gaining 5% year over year. So it's a net. And if interest rates go up more, you're going to lose out. Taking the lump sum and expect interest rates to fall, I don't think they're going to fall any further than they have here since we've hit historic rates the last go around here. Probably only one way to go, at this point. So the retirement planning timeline, when we're looking at retirement. So at retirement is when you can do the savings plan rollover. You can't actually roll over your Voya plan until you've actually separated from Exxon or any employer. You can't, some plans allow you to pull money out if you're 59 and a half or older, but typically you can't access the 401k plan in its entirety until you've actually left the company or are in retirement. So first of all, don't make any withdrawals or Roth conversions prior to doing a rollover. That can tie things up. Only do this after you are clear on what your plan is. Like I said, don't be in a rush to roll over your 401k if you're 56 years old, because then again, that 10% early withdrawal penalty can come back into play. Review your cash flow plan. That's going to be in line with that. Review your NUA plan. Review any tax issues, estate plans. How do you have your inheritance set up? Review the investment plan. Have a strategy on how you're going to invest the money before it rolls over, because you don't want it just rolled over sitting there and then you're figuring out what you're going to do with it. Have that all planned out ahead of time. You don't have to do anything with the Voya plan immediately. You got time for that. Any 401k plan. Review your questions before making the rollover call. So when you call Voya, this is how it goes. Basically, you can do it post-retirement, usually within a week or two. Voya verifies whether you're eligible, meaning they've gotten the separation notification from benefits. Any quadro hold has been released. You tell Voya basically how many shares of NUA you want to do. the disposition of the remaining shares. Usually we just roll those over in kind, where the IRA is held, what custodian, where that gets rolled over to. So this is for the pension and the 401k. In order to classify it as a direct rollover and not have any tax implication, the check is made payable to the custodian for the participant's benefit. By making it payable to the custodian and not payable to the employee or the participant, that classifies it as a direct rollover, and it rolls over. You still receive a check, or sometimes with Voya, they can send it to the, not the pension check has to come to you. The 401k check, they can actually send it directly to the custodian. But basically, by making it payable to the custodian for your benefit, again, it's classified as a direct rollover, no tax implications. You will get tax forms. They're 1099s. For pre-tax money, it'll have an Iras code of G. For Roth monies, an Iras code of H. Basically, you use that when you file your taxes, and there's no tax implications, but you will get tax forms around that. So when you get a tax form, don't freak out and think that, oh gosh, I'm going to be taxed on, whatever my 401k is. That's normal to happen. It's what the code is that matters. Then the disposition of any remaining after-tax amount, you can, again, have that paid out to you, not pay any taxes. Typically, we look at rolling that over to a Roth, get it tax-free if we haven't already been pulling out the after-tax money and throwing it into a Roth ahead of time. So basically, you usually have to repeat this twice. You go with one Voya agent, get a second Voya agent who's a distribution specialist, and they send it out to you. Voya calls take a long time, anywhere from 45 minutes to an hour and a half. So whenever you do your Voya call, make sure you block off enough time. We suggest doing it with us, with an advisor, walk you through it. Basically, you can call Voya. We have the plan already in place on what we want to do. You talk to Voya, give them permission to talk to us, and then we just take care of it for you. We give them all the instruction exactly on what we need to do, make sure no mistakes are made. If mistakes are made, we check it over when we get distribution summaries, call them back and get it fixed. So consultant advisor, there's a lot of choices to be made in retirement. Some of the things also, Medicare is a big one. Didn't get into that too much, but Medicare is a big one you got to decide on in terms of a supplement. Again, how you take your Social Security, how you spend your money, managing the retirement account distributions, the distributions at 72, tax planning, again, a big one, portfolio planning, how do I invest my money, employer, pension, annuity, lump sum, combo, what do I do? It's complicated. Let us run the numbers, let us consult you. We're here to help. We don't charge anything for consulting. So we are happy to sit down, put together a plan. We use this as an opportunity to get to know you. It's no obligation, no cost. We're happy to help you figure all this out. So as I mentioned, we're happy to help. We are offering one-on-one financial strategy sessions. So feel free to reach out to us for that. So thanks for attending. This is all of our contact info here. This is me, Mike Camara. Here's my email, phone number. Feel free to reach out to me directly, or if you already have a relationship with one of our advisors, feel free to contact them on any of the topics here that you'd like to go over. Let me just make sure there's no other questions that have come up. Nope, we don't have any. So thank you very much for your time. Really appreciate it. And reach out to us if we can help. Have a great day.